Welcome back to Build Wealth Now News. I'm your host, Billy Bob, and sitting across from me, as always, is our brilliant co-host and lead market analyst, Sarah. Sarah, today we are diving deep into a stock that I think 90% of retail investors are completely overlooking. They hear AI boom, and they immediately buy Nvidia, AMD, or TSMC. But today we're talking about the company that actually puts the finishing touches on those AI chips before they go into the data centers. We're talking about Amkor Technology, ticker symbol AMKR.
Hey, Billy Bob. Great to be here. And you're absolutely right. Everyone is focused on the companies designing the chips or fabricating the silicon. But Amkor is the largest U.S. headquartered OSAT that's outsourced semiconductor assembly and test. If TSMC is the master chef cooking the silicon wafer, Amkor is the high-tech packaging and delivery service that makes sure that fragile, multi-billion transistor chip actually survives and functions in the real world.
I love that analogy. So let's kick this off with topic number one, the business analysis. Break down exactly how Amkor makes money for our viewers.
Sure. Amkor operates in the back end of the semiconductor supply chain. Once a foundry like TSMC prints the circuits onto a silicon wafer, those wafers are sent to Amkor. Amkor cuts them, packages them into protective casings, adds the tiny metal pins that connect the chip to a circuit board, and rigorously tests them. They make money through two main streams. Mainstream packaging, which is high-volume, lower-margin stuff for consumer electronics and cars, and advanced packaging. Advanced packaging is where the magic and the money is right now. This involves 2.5D and 3D stacking, where they literally stack memory and logic chips on top of each other to make AI processors faster. Advanced packaging is growing explosively, and it's driving their record revenues, which hit $1.9 billion in Q2 of 2026 alone.
$1.9 billion in a single quarter. That's massive. But Sarah, where are they in their corporate life cycle? That brings us to topic number two, business phase analysis. Are they a scrappy startup or a mature cash cow?
This is where it gets really interesting, Billy Bob. According to our proprietary phase classification, Amkor is currently in a tug-of-war between Phase 4, operating leverage, and Phase 5, capital return. On one hand, they are a mature company. They pay a consistent quarterly dividend, and they recently authorized a $300 million share buyback program. That screams Phase 5, capital return. They are rewarding shareholders. However, because of the AI boom, they are simultaneously in Phase 4, operating leverage. They are spending billions, literally a $7 billion campus expansion in Peoria, Arizona, to build out advanced packaging capacity. So they are taking their mature cash flows and aggressively reinvesting them into high-growth AI infrastructure.
So they're paying me a dividend while simultaneously building the factories of the future. I like that. But in the semiconductor world, it's a brutal dog-eat-dog business. Let's talk about topic number three, moat analysis. Does Amkor have an economic moat, or can anyone buy some machines and start packaging chips?
We classify Amkor as having a narrow moat, primarily driven by switching costs and intangible assets. Here's the thing. You can't just slap an AI chip into a plastic box. Advanced packaging requires co-engineering. Amkor works with fabless designers like Nvidia for years before a chip even goes to production. Once a chip is designed for Amkor's specific system in package, SiP architecture, switching to a competitor would require millions of dollars and years of retesting. That's a massive switching cost. Furthermore, they hold thousands of patents in thermal management and heterogeneous integration. It's a narrow moat rather than a wide moat because they still face intense pricing pressure from Asian competitors in the mainstream packaging space. But in the high-end AI space, they are deeply entrenched.
Entrenched is the right word. And speaking of being entrenched, let's move to topic number four, growth driver analysis. How are they actually growing the top line? Is it just the general economy, or do they have specific catalysts?
They have two massive historic catalysts that completely de-risk their growth profile. First, existing customer expansion. They just signed a multi-year $1.5 billion prepaid agreement with Nvidia. Nvidia is literally handing Amkor cash upfront to expand US-based advanced packaging capacity for its AI chips. Second, geographic and market expansion. Amkor signed a 10-year strategic partnership with TSMC to co-locate advanced packaging right next to TSMC's new fab in Arizona. This is a game changer. It secures their utilization rates for the next decade and positions them as the ultimate friend-shoring beneficiary for U.S. tech companies that want their supply chains out of Asia.
A 10-year deal with TSMC and a $1.5 billion check from Nvidia. Wow. Okay, let's look under the hood. Topic number 5, business key financial metrics. What is the Zacks data telling us about their actual financial health right now?
The metrics are flashing green across the board for a Phase 5 company. Zacks currently ranks AMKR as a number 1 strong buy. Let's look at the Phase 5 scorecard. Revenue growth. They are growing revenue well over 10% annually, driven by that 26% year-on-year or YOY surge in Q2. That's a green. Earnings growth. This is the headline. Analysts have unanimously revised their FY1 EPS estimates upward. We are looking at a projected 74.67% EPS growth for this year. EBIT to interest expense. They have a very healthy balance sheet with strong debt coverage, easily clearing the 5 times threshold. Capital returns, green. They've paid dividends for over a decade. The only yellow flag is ROIC, return on invested capital. Because they are spending billions on the Arizona facility, depreciation is temporarily weighing on their ROIC. But as that capacity comes online and fills up with Nvidia chips, that ROIC is going to explode higher.
So the earnings are there, the growth is there, but I know you, Sarah, you're always looking for the bear trap. Let's get into topic number 6, risk analysis. What could go wrong? What keeps the CEO up at night?
3 main risks, Billy Bob. First, disruption risk. Red. The biggest threat to an OSAT like Amkor is the foundries themselves. TSMC and Samsung are starting to do their own advanced packaging in-house, like TSMC's CoWoS. If the foundries insource the packaging, it cuts Amkor out of the loop. Second, concentration risk, yellow/red. That $1.5 billion Nvidia deal is amazing, but it also means Amkor is heavily reliant on a few massive hyperscalers. If AI CapEx spending cools off for even 2 quarters, Amkor's new Arizona factory could sit empty, and the depreciation will crush their margins. Third, outside forces, red. Geopolitics. Amkor has a massive footprint in Asia. They are currently exploring a partial sale of their China operations valued at up to $1.5 billion just to mitigate U.S.-China tariff and export control risks. Navigating this global minefield is expensive and complex.
That makes sense. You build a $7 billion factory in Arizona, you better make sure the AI boom doesn't bust. So, knowing the risks and the rewards, how do we price this thing? Topic number 7, valuation metrics analysis. What metrics should our viewers be looking at, and what should they ignore?
Because Amkor is a mature, capital-intensive manufacturer, you must completely ignore the price-to-sales P/S ratio. In the OSAT business, gross margins are relatively thin, around 16%. So top-line revenue doesn't tell you the real story of cash generation. Instead, you must focus on the forward price-to-earnings, PE, and price-to-free cash flow, PFCF. Right now, at roughly $54 a share, Amkor is trading at a forward PE of about 20.2 times. When you compare that to their projected EPS growth rate of nearly 75%, their PE ratio to earnings growth, or PEG ratio, is incredibly low, under 0.5. In the semiconductor industry, where peers are trading at 30 times or 40 times forward earnings, Amkor looks fundamentally cheap relative to its growth trajectory.
A PEG ratio under 0.5. The value investors in the chat are going to love that. But let's talk about the tape. Topic number 8, price and sentiment analysis. The stock has been a roller coaster. What is the market sentiment right now, and what is the CMT Chartered Market Technician perspective on the chart?
Sentiment is highly bifurcated. On one hand, institutional sentiment is incredibly bullish. Analysts are tripping over themselves to raise their price targets because of the Nvidia and TSMC deals. On the other hand, insider sentiment is bearish. Over the last 12 months, insiders have been net sellers, offloading over $13 million worth of stock. Now, this could just be routine executive compensation and tax planning, but when the stock is near all-time highs, it makes you pause. From a CMT technical perspective, the chart shows a stock with a massive beta of 2.24. It's highly volatile. It ran up from a 52-week low of $22 to a high near $96, and it's currently consolidating in the $50 to $55 range. Technically, it is holding above its 200-day moving average, which is a bullish long-term trend. However, the massive volume spikes on down days suggest that big funds are taking profits after the AI hype. A CMT would say the long-term trend is up, but expect violent 15% pullbacks along the way.
Violent pullbacks. Good warning for the day traders. Okay, Sarah, this brings us to our final fundamental piece, topic number 9, analysts' price targets and the discounted cash flow DCF model. We have some wildly different numbers here from Zacks and Simply Wall Street. Explain this gap to the audience.
This is the most fascinating part of the AMKR thesis right now. If you look at Zacks, their near-term analyst consensus target is $57. That's only about 5% upside from current levels. Zacks is modeling the near-term pain, the heavy capital expenditures, the depreciation drag on margins, and the execution risk of building the Arizona campus. But if you look at a long-term discounted cash flow, DCF model, like the one from Simply Wall Street, their intrinsic fair value estimate is a staggering $97.49. Why the $40 gap? Because the DCF models the 2030 financial targets. Management has stated that by 2030, they expect revenues to exceed $11 billion and EPS to hit $5. If they achieve those AI-driven targets, the cash flows generated in years 5 through 10 are massive. Zacks is pricing the construction phase. The DCF is pricing the harvest phase.
Wow. So Zacks is looking at the next 12 months and the DCF is looking at the next decade. Sarah, before we give our final verdict, I want to put on the hats of the greatest investors in history. How would Peter Lynch and Warren Buffett view Amkor Technology?
Oh, I love this exercise. Let's start with Peter Lynch. Lynch loved boring companies with niche monopolies that Wall Street overlooked. He'd look at Amkor and say, everyone is buying Nvidia, but nobody realizes that Nvidia's chips are useless without Amkor's packaging. It's a boring name, it's an essential service, and it's a hidden AI play. Lynch would love the low PEG ratio and the fact that it's a picks and shovels play in the AI gold rush. He'd probably call it a potential 10-bagger if the market finally re-rates it from an industrial packager to an AI infrastructure tech stock. Now, Warren Buffett is a tougher sell. Buffett hates capital-intensive businesses that require constant heavy spending just to stay alive. He famously avoids semiconductor manufacturers because you have to keep rebuilding the factory every 3 years. He would look at Amkor's $7 billion Arizona build-out and grimace at the depreciation. However, Buffett also loves long-term contracts and toll bridges. The 10-year TSMC agreement and the prepaid Nvidia contract act as a massive moat. Buffett might pass on it because of the capital intensity, but Charlie Munger might have argued that the switching costs in advanced AI packaging create a toll bridge that is worth paying a premium for.
Incredible insight. So we've covered the business, the moat, the risks, the chart, and the legends of investing. It's time for the bottom line. For the viewers watching at home, holding their phones, waiting for the signal, what is the verdict on Amkor Technology? Is it a buy, sell, hold, or do nothing?
Here is the Build Wealth Now official verdict. For our viewers who already own AMKR, the rating is hold. Do not sell. The insider selling is a slight yellow flag, but the fundamental thesis of the AI packaging supercycle is just beginning. You want to hold through the volatility to capture the 2028 to 2030 cash flows. For viewers looking to initiate a new position, the rating is buy on dips. Do not go out and buy a full position at market price today. Because of that 2.5 2.24 beta and the technical consolidation, you should set limit orders in the low $40 or high $30. Use the market's short-term fear regarding CapEx and depreciation to buy a long-term AI toll bridge at a discount. And finally, for our short-term day traders, the rating is do nothing. The stock is too volatile, the insider selling creates unpredictable overhead resistance, and the news cycle around AI is too erratic for quick day trades. This is a 3 to 5 year hold.
Buy on dips, hold for the AI harvest, and ignore the day trading noise. Sarah, you have absolutely crushed it today. The research on this OSAT giant is top-notch. Viewers, if you found this deep dive valuable, do me a favor. Smash that like button, subscribe to the channel, and hit the bell icon so you never miss a market breakdown. Drop a comment below and tell me, do you think TSMC will eventually push Amkor out, or is Amkor's moat safe for the next decade? I want to read your thoughts. Until next time, keep your charts clean, your moats wide, and keep building wealth. We'll see you on the next broadcast. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.